Welcome to this Killik Explains finance video. This week, is there a way to spot stocks at risk of earnings shocks? Easy for me to say, but if there is a way, that's quite useful because the last thing you want as an investor is an earnings surprise on the downside and a big stock sell-off that catches you unawares. So that's the basis of what I'm going to talk about now. So in a nutshell, the problem is this: profit and loss accounts are prepared on an accruals or matching basis. Now this is not an accounting video. Essentially, what companies have to do when they put together profit and loss accounts perfectly legally is book income that's been earned, book costs that have been incurred, but those words are not the same as cash received, cash paid. So you can often get a difference, thanks to something called accruals, is the technical term, between the income statement, if you like, the earnings number the company puts out, and the actual net cash it's generating. And the bottom line is, the fact that there's a difference there leaves firms with scope to move profit around from one period to another. And as an investor, that matters, and I'll try and tell you why in just a moment. Now, spotting it requires a bit of detective work. There is a number called the accruals ratio, there it is, which is one way of spotting firms that are being a bit aggressive with their accounting, and I'll try and explain that in just a moment. And it tries to uncover stocks where heavy use of accruals is going on, there's a mismatch between income and cash flow, and therefore in the future you might get a nasty shock. Why? Well, how profits can be flattered. So let's take a look at it. This is not an accounting video per se, just a quick snapshot. So it's a very simple example. Let's imagine a firm is sitting down, mapping out what profits look like over 3 years. So expected profits, the trend is not looking that great. All right? Declining expected profits. So 100 year one, 80 in year two, 50 in year three. Well, that's not great. That's not going to make shareholders happy and investors want to buy the stock. So what do we need to do? If, very simple numbers, you could basically say, well, looking ahead, we can see some sort of nasties, some things that need to be provisioned, as it's called, some things we should book into year one's profit and loss account as costs now, because we've got to be conservative, be prudent. Investors don't like surprises. So let's assume there's 50 million of those, or 50 of those. Then you might be thinking, this is nuts. So in year one, you're going to reduce the profit figure down to 50. Why would you want to do that? Well, look at what happens next. In year two, we're not going to touch this line here, the accruals as it's called. We'll just leave that sort of bit of profit tucked away, that 50, until year three, when we're going to release it back against profits. So we're going to say, actually, we were a bit conservative in year one, turned out we didn't need to bother, and release it back. And can you see that if you were allowed to get away with that legally, suddenly you can change a not very promising profits profile into a much better looking one, in the hope maybe that investors won't necessarily spot what you've done. Because you might say, well, it's pretty obvious, isn't it? Investors should be able to see that that is different to that, but actually the way these things are booked sometimes is less obvious than you might think. Enter the accruals ratio in a moment. So, reason this matters, the underlying profit trend is down. You can see that quite clearly. Through the use of accruals, this can be managed. I mean, I suggested it can be reversed. That's fairly aggressive, but it's certainly be managed a bit. And investors might be easily duped, therefore, into what the true level of profits is. And if they are, then when the company disappoints, you've got a problem. Because if you think about it, back here, all right, this is a company that's not doing terribly well, massive scope for an earnings shock. Because if investors are thinking, well, this is the pattern, and actually something goes wrong here, then you get a nasty surprise and a big sell-off. So that's the reason this matters. So in a nutshell, the accruals ratio says, is there a way to spot this? And the answer is, potentially there is. So it's a simple idea. It's one number. That's always enticing for investors, but it needs a bit of graft to find all the components. And I'm not going to go through all of that right now, but be aware there is a bit of work required to get the number. It is then a formula to knock it out. So once you've got the data, net income, free cash flow, I'm making this sound very straightforward, you basically compare the two and divide by total assets. Balance sheet assets, if you like, total assets. The lower the answer, the better. Now why? Quick example coming up. So company A, net income, that's from the profit and loss account. That's the earnings that are being reported, 100 million. Free cash flow, only 80 million. Total assets, 200. All right. So in other words, the company is booking more income than it is generating cash flow, if you like. So the accruals ratio mechanically would be 100 minus 80 over 500, or 10%. And the chap who came up with this idea says that the more positive the number, the less reliable the earnings number. Now, you don't need a ratio to tell you that, Basically, the bigger the gap between income and cash flow, potentially the more dubious or the lower quality the profit number in the first place. Company B, on the other hand, net income of 80, free cash flow this time 100, all right, so bigger free cash flow than income, assets of 500, the accruals ratio mechanically, according to my formula, 80 minus 100, so comparing those two again, gives you minus 4% overall. And the smaller or more negative the number, according to this theory, and don't forget we're not looking at anything else in relation to the company, the better. So, purely applying the theory, company B is better, all right? Why? Now, here comes the theory. So, a chap called Richard Sloan reckoned he demonstrated this quite successfully. Paper in 1996 from the University of Michigan, a 40-year study period in US equities. Basically, his conclusion was shares with low or negative ratios tend to outperform their peer group, and they do it by quite a chunk. In other words, high positive ratios, so my company A, my 10%, tend to lag by around 10% annually, and that's a sizable difference, all right? Weighing it up. So why is that again? And today, how reliable is this as a single guide to which stocks you should buy and which ones you should avoid? Well, fans say this still works. So it works because investors tend not to screen carefully enough between firms that have a big difference between income and cash flow, in other words, might be using accruals quite aggressively, and ones that don't. They then get caught out because big accruals firms tend to have lower quality P&Ls and are more likely to surprise on the downside, and because you're not expecting it as an investor, you aggressively sell off the stock, and it all goes a bit pear-shaped basically. Low accruals firms, on the other hand, will tend to deliver earnings surprises, all right, because they've got a higher quality profit and loss account. So fans say the theory is still valid, and there's some evidence to suggest it is, but you've got to compare apples with apples. So smaller firms, for example, tend naturally to have bigger accruals than larger ones, because simply to grow a company, you tend to have to basically wait for cash to come in from your customers and so on. Single ratios can be dangerous. So a lot of people say, actually, this ratio's had its day in isolation. It should be factored into a broader metric like the Piotrowski F-score, which is something I will leave to another video. All right, the cat's out of the bag. So some people would say, well, this study, 1996, 40 years of data, yeah, but as soon as you publish it, surely everyone just goes, well, I'll basically buy low negative accruals ratio firms and dump or even short, if you're a hedge fund, the ones with the big positive numbers on this basis. But actually, there is some evidence that the accruals ratio theory still persists. And the reasons are many and varied. So, you'd expect professionals like hedge funds to have arbitraged this away. In other words, just, profited from the very existence of the anomaly, if you like. But actually, because high accruals firms can be illiquid, there's various debates around this, volatile, and getting your timing right can be tricky. There's some evidence suggests, more recent papers, that there is something in this accruals ratio theory. All right. Now, my point would be, in conclusion, it is just one number, all right? And as such, I would never invest on the basis of one number, but the underlying message is crucial. As an investor, do not be blind to differences between income in the profit and loss account and cash flow in the cash flow statement. And if nothing else, this ratio is a reminder of the importance of that relationship. So, editor@killik.com with any queries. And if you'd like to see related videos on other financial ratios, then it's killik.com/learn. And a good place to go is the financial statements and or the shares tabs.